TheoTrade. This is Don Kaufman. September 18th, 2020. Doing the weekend update here on a Friday evening. Volatility just perplexing the markets. Why do we start with that? Well, simply because there's been some pretty strong sell-side activity, right? In the last 3 weeks of trade. What's volatility done for us? Absolutely nothing. You know, the reason I wanted to actually start this weekend's update right here in the S&P is specifically I'm looking at the spiders, but the reason I wanted to start here is we think of markets selling off here, which they absolutely have, and really some pretty fast chopped out trade. Nevertheless, we hit today in the S&Ps into full-blown corrective territory. And this is exactly what I wanted to start with over here. Why? Because you're actually seeing approximately a 10% decline from some of the recent highs to effectively where we're currently at. So we're in kind of corrective territory. All right, you know what? Let's also bring up the QQQ while we're at it. Well, if you take a look at the Qs, the Qs were actually up, and a staggering 40% on a year-to-date basis are now up just north of about 23%. The interesting thing about the QQQ, they almost pulled back into full-blown bear market territory inside of today's trading session, narrowly escaping, I should say, the bear market territory in here. Why am I bringing this up? Like, oh, all right, price action. You look at price action. It's all well and good. Yeah, this is where volatility comes into play. Now we're actually going to take a quick glance over the VIX. Now, I am not exactly a huge proponent, if you will, of looking at the VIX, and we're going to look at the volatility futures here momentarily. But during some of this fairly heavy sell-side activity, you have to look over at the VIX and see the VIX sliding to the downside, the VIX back to the 25 handle. And people, there's no question about it. You know, the S&P's finished down some 33 handles today, and well, the volatility actually finished down on the trading session. You know, I was talking about this in last weekend's update, but I'm going to go even into more detail about it because there's just there's no good spin that you can put on what's going on with this volatility. When I say no good spin, I mean, listen, no one's feeling the fear. There's no volatility pump. There's no aggression to the selling. And I'm actually going to explain each of those terms and kind of what they mean specifically to me. But it's just not there right now. And the market is in essence just drifting to the downside. Yet, I mean, at one point today, the S&Ps were down basically 70 handles, and still the S&Ps failed to pump in volatility. In fact, just for a brief moment, I'm actually going to bring up a screenshot, which I just don't do all that often. But this is a screenshot, and this screenshot was actually taken here on this Friday. You know, there's quadruple witching going on. It was taken about 10 a.m. Pacific time, and what I wanted to show you on this screenshot at this point in time, the S&P futures, okay, forget about the fact that the Nasdaq is down over 2%. The S&P futures, because that's really what's going to drive a lot of the flow, and that's specifically what's going to drive like volatility. The S&P futures are down 44 handles. Volatility futures massively unchanged. The VIX is actually down at that point in time. That's why I took the screenshot. I just, you know, there's a lot of things you're going to see, you know, in the course of your trading career. That right there, people, that one's memorable. Was the last time you saw the S&Ps down over 1% with volatility? There's no pump in that volatility at all. Now, let's actually get into that. When I say there's no pump in vol, okay, basically what I'm alluding to is if you take a look at the volatility futures and forget for a second about looking at the chart, right? The volatility futures always tell a story, but to understand that story, you have to understand front and back month vol futures. And what that basically amounts to is we'll look at like October vol futures. Okay, forget about all these weeklies. They do not trade. We look at like 61-day vol futures, 89-day vol futures, right? So we're out a little bit in time. And when I say like volatility futures, if you understand how to read this, they tell a little bit of story. And the story goes like this, okay? The volatility right now is, roughly speaking, kind of the same as it would be, you know, out in the November expiration, which might make sense because there's election coming up. And the volatility is already pumped in a little bit for the election, okay? But the thing that just doesn't make any sense at all, and the big story in here is that volatility, it's just nowhere to be found. Like, I get it. The vol futures here are at 30. Like, I do. Okay, but why aren't they up 2 points? Why aren't they up 3 points? Why isn't volatility sitting at like the 34 or 35 level here? Again, it's indicative of not just about volatility. And by the way, we can even drive a little further out in volatility land over here, and you'll see it'll kind of drop back off. We're not in like there's no big volatility kind of inversion. When I talk about volatility inversion, that means that the front month vol starts exceeding back month vol. All right, and the vol skew would actually look something like this, where front month jacks to 35, some of the back month, like at 32. We're just not there. I mean, the vol skew right now is just kind of lovingly flat. It's pretty mellow out there. And that's why, I titled this, Volatility is totally perplexing. Like, if you're not perplexed by volatility, the bottom line is you just don't have experience enough to understand that you should be perplexed by volatility. Because, again, I even talked to volatility arbitrage experts, and everybody throws the hands up in the air. We all agree on one aspect. There's been a ton of retail traders, and those retail traders have been they were buying and buying and buying and buying calls during the big gamma squeeze. That was the squeeze to the upside. So I'll bring up the QQQ. We all agree that during this wild ascent to the upside, the QQQ and all of your Nasdaq stocks like your Microsoft, your Apple, when they were getting all pumped up, there was a ton of call buyers. And we assume that those buyers are now call sellers, right? So they're selling a ton of options. So there's a huge, options in the end are supply and demand, right? Here there was a huge demand. Here there's a huge supply. And that might be suppressing volatility to a degree, but it still wouldn't explain when the S&Ps are getting smoked on a trading session that nobody starts to feel the fear. And moreover, I looked past volatility. I had to. And when I say I looked past volatility and I had to, I simply mean this in context of, forget volatility for just a second. I looked at the S&P futures, and one of the things that's really kind of resonating with me, and that's where this comment came from. And when I say this comment, I'm talking about the no aggression to the sell side activity. That's one of the more serious moves that you've actually seen in recent history inside of the S&Ps. And that serious move barely spiked the S&P futures to like 13,000 contracts on what? On an expiration day. You know that contract size is usually elevated anyway on an expiration day. This is, quarterly expiration. So what? It was kind of a non-event that the marketplace sold off. And when I'm talking about the marketplace selling off like this, that might not look like much, but these are 1 minute candles. And in roughly speaking, 1, 2, 3, 4, 5, we'll call it 6 minutes. We actually traded from 33.04 all the way down to 32.80. Basically almost a 23, 24 point drop inside of the S&P futures. Not a huge amount of volume, okay? And at the exact same point in time, that happened, and again, just to be able to mark time, so you actually see this fall here is roughly 10:23. We actually switch over to the volatility futures, okay? 10:23, did they take off to the upside? Yeah, they took off to the upside and then did absolutely nothing, okay? It was again, very humdrum. There was no spikes in volume in here. It was like the entire professional world just looked at the marketplace, shrugged the shoulders. Now, everybody looks at something like the S&Ps, okay, and they think to themselves, have we bottomed yet? First and foremost, all right, when the question comes up, have we bottomed yet? Yeah, we've seen a little sell-side activity the last 3 weeks, and it really kicked in, okay, again, about 3 weeks ago. This is a week, here's a week, here's a week. That's what these little lines, of course, are. Those are our expected moves. But net, this week, we were just down nominally. So, this particular week, we're down nominally, so maybe we shouldn't see a big pump up in volatility. Nevertheless, the question kind of comes into play, is are we going to be near a bottom? Because everybody asks that. Are we going to be near a bottom? I don't see any big volume spikes, okay? What I say in here is we ain't home yet. Because according to volatility, okay, we haven't even left the station. And that's one of the things I really want to resonate with you, because as I said, I can't find a positive spin to what I'm looking at. Like, look at the IV ranks. This is implied volatility rank. Implied volatility rank, if you're on Thinkorswim, implied volatility rank is found under option statistics. They also obviously have IV ranking. We're on Tastyworks more and more every single trading session, but most people are familiar with some of the charting package here, obviously, in Thinkorswim, so I continue to use this. But here is again, the IV, all right, that IV rank. Now, all I'm basically doing over there is taking this IV ranking, and I'm actually plotting it on a chart. And you can see, like, does this look like anybody's feeling the fear? Right? And I'm telling you right now, you haven't left the station yet. You need to feel the fear. Does that look like somebody's like feeling the fear? Okay, but that's the spiders. What about the Qs, Don? Because the Qs are where the real sell side is happening. I agree with you. Okay, take a look. The Qs, all right, this is a little bit different in here because the QQQ, they did actually have a decent sized down week. Take a look at the auto expected move here. So we're actually going to snap to auto expected moves. The Qs actually did tag the lower edge of the expected move. But when you start looking at the ranking, it's almost like nonchalant sell side activity. The other aspect in here that really is sticking with me is that all your other risk assets continue to kind of stagnate. Bonds, utilities, gold, dollar. Look at them, right? I'm not going to spend a huge amount of time on this, but when you're talking about, risk assets, there's no flight to quality, and at the same time, nobody's bailing the bonds. Okay, I mean, I can imagine that if the marketplace, if the S&Ps really started to tank, traders would be flying into the bond products. I can also imagine a scenario that if the S&Ps really started to tank, the bonds could even sell off because they're liquidating bonds, right, just to basically be able to cover themselves. But again, neither is happening. Like the bonds, they're just not moving. They're just oscillating back and forth. In fact, I looked at something really interesting today, and I think you guys will find this also. This is the TLT. This is the bonds. It's the bond ETF. And I looked at the implied vol range. Take a look at this. Okay, the IV range, or I should say rank, is all the way down to like the 9th percentile, which is just, I mean, it's not just low. It's the lowest it's been basically inside of a year. In fact, I even snapped this open a little while ago to like 3 years. And you got to go back like 2-3 years to even see the implied volatility being as low as it is inside of the TLT, right? So what gives? Bonds, risk assets, totally stagnant. Utilities. I wanted to bring up utilities because the XLU, right? XLU, and this is the way I like to look at the utilities, they won't budge. Little sell side activity today, which I thought was kind of unusual, but they're just not budging. Their volatility too, totally dead. Okay, where else do you want to go? You want to go to gold? Gold has been a horrific hedge in this sell side activity. It's non-existent. You want to talk about inflation? The Fed came out, nothing. Everybody's blaming the sell side activity. It's the Fed. What did they say? Anything that you haven't heard before? Okay, come on. We're going to be facing some severe headwinds. Everybody knows that. You didn't need Jerome Powell to tell you. Okay, and then we have the dollar, and we can bring up the dollar all day long. It hasn't done anything either. No matter where you look, okay, volatility isn't moving. Bonds are not moving. Utilities are not moving. Gold's not moving. Dollar's not moving. The monsters of tech. Next on the list, yeah, they're moving. This is actually our new monsters of tech symbol. The reason I like to bring up the monsters of tech, and this is Apple and Amazon and Facebook and Google and Microsoft, it's a conglomerate symbol. And I've even got the ratios in here for you, right? So if you take a look at this, right, the monsters of tech, and why I wanted to bring this up, I was talking about, bear market territory. Yeah, you're pretty much home here. The monsters of tech were actually up over 50%, and now they're only up approximately 27%. So when it comes to the monsters of tech, yeah, we're actually in bear market territory. We're in bear market territory. The QQQ volatility can't get off the floor. The S&P volatility can't get off the floor. Your risk assets aren't moving. Okay, again, this brings me to the one conclusion. I'm going to reiterate last week's warning. You don't buy the dip here. You could sell the rip. Sell the rip basically means when they bounce and bounce big. I'm probably going to short into it, but I'm not out there just shorting stock. Listen, I have a lot of short stock positions. In fact, I'm going to recap some of my positions, but when I talk about like short stock positions, I have a lot of them. I'm short some NVIDIA. I'm short a couple of hundred shares of Apple and some Facebook, a little bit of Home Depot. I'm actually got a short position inside of Nike and, UPS. The UPS is not going so well. But, net, some short positions. How do they perform in a week like this? I'll aggregate everything. Okay, weeks like this, they're gold for me. I mean, again, I started the week at basically $590,000, ended the week at about $622,000. I'll take it. I mean, I'll take those kind of weeks all day long. And because net, the point I'm making with this, okay, I'm receiving incremental gains, but the point I'm making with this, the S&Ps really didn't do that much. It's all about the monsters of tech and a fairly precipitous slide without volatility going up. Just, again, the reason I'm bringing up my positions in here, because, of course, everybody's asking me, are you covering them? Are you covering? Come on, Don. You're up 13% in Apple on 400 shares. You're going to cover it? Not a chance. Not a chance. I'm not, and I'm not going to turn around and buy the dip over here either. All right. Until volatility actually says otherwise, I'm not doing anything. Okay, because all I have to do is look at this, and I still think that there's phenomenal risk reward over there. Again, I'll reiterate that warning: don't buy the dip. Next thing I wanted to talk about: election risk. The election risk. Also, when it comes to volatility, this is really funky. The election risk is shifting on us right now. And again, I'm going to bring you out into this because not everybody necessarily knows how to read like volatility. So what I'm actually bringing you into is if you take a look over here at the this right-hand side of Thinkorswim and take a look at like the November expiration. This is where your election risk should be. It's gone. It already shifted all the way out to December. Okay, so apparently the election, it's almost pricing it. This is mild skew. It's pricing the election in large part as like a non-event. And this is, listen, you talk about like being bipartisan. This is about as bipartisan as you could possibly get. The election is also, there's no spike in volatility. There's more volatility right now, mildly in December than there is in November, which is a very concise indication that risk is coming in December, which means we're probably not going to know anything in November, which we've heard, out of a lot of different sources here. But the volatility this week is actually confirming it. And then on top of it, okay, to I guess add a little bit more complexity to this, the volatility takes back off again out in January, and I don't even have a clue as to what's going on inside of that one. All right, a couple of position updates, just 3 positions because I get a lot of questions on this. Lululemon. Let's start with Lululemon. I am continuing to maintain my duration position in Lululemon. Okay, I'm stacked in here. I'm using deep in the money puts. Deep in the money puts as a synthetic short stock position. Obviously, I have a multitude of different positions. These positions are absolutely a rockin' now. So talk about the comeback of all comebacks. Stock shoots to 400. I'm ready to throw in the proverbial towel on there. Okay, yoga pants cannot beat me. But we've had a little bit of a pullback now. So Lululemon, you don't even have to bother asking at this point because the question I keep getting in email is, are you bailing out? Or, I was getting that question at 400. Now I'm getting the question here back, at the price point of, the 295. I'm not getting out of Lululemon anytime soon. Okay, call me when things really start to get interesting. If Lulu gets down to about the 200 level, I might look to exit some of the contracts. But at least we're headed in the right direction over here. And again, I was talking about a little bit of like bear market territory. This thing was up 70%. It's now up 26% on a year-to-date basis. Again, when things work, and the reason I really wanted to bring up Lululemon is not to be like, oh, it's finally working. Listen, when things work, do more of what works and less of what does not. And in this particular case, don't even bother asking if I'm going to bail out of here. Why? It's working. Like I haven't seen an uptick in Lululemon like literally inside of 3 weeks. Why would I even consider, bailing out of a position like this? I would anticipate some ripping rallies inside of Lulu coming. I would. I'm not going to do anything. I'm let it rip. Okay. At this point in time, though, it's headed the right direction. Next one on the docket, XHB, the home builders. Okay. Home builders. And this home builder, this ETF is actually filled with stuff that isn't technically home builders. Nevertheless, this thing is 3 days removed from the all-time high. Okay, I've actually stepped in and upped some of the short positions. I had a very mild short position in here. I'm using, again, these are duration positions, and I want to clarify duration position. This is not something for tomorrow. This is not something for a week from now. These positions are out there. Okay, I don't even expect this thing to come down in the next 3 months. I'm actually going to continue to roll it, but I'm citing simply risk reward. This has nothing to do with fundamentals. Okay, I think it has a spectacular, downside opportunity versus the upside. And that's just a very simple way of me saying is, again, is there upside left in this product? Absolutely. I mean, let's say that the XHB can cruise all the way to 65, no problem. Go to 65. Yeah, but it could also drop like a rock back down to 30 here in no time at all. And I think that alone, that is what I kind of cite as risk reward. For me, that's viable. And this is a product that, I'm not new to the XHB. I actually caught the XHB and most of this move to the downside inside of the the coronavirus crash, the onset of that. I'm going to do it again. Next one, XLP. XLP, very, very similar in context is the XHP. This is actually consumer staples, seeing a little bit of sell-side activity. I've rolled out some of my positions in here. Nevertheless, I am maintaining duration positions 90 plus days out in here, looking for more sell-side activity. Again, the LULU position, the XHP, the XLP, those are all duration positions. Last but not least, on this weekend's update here, the expected move. So we cruise over to the SPX, we take a look at the expected move. We are this last week of trade. And again, I just want to highlight this for a second and kind of bring it to your attention. This last week of trade, and I stress this again, yeah, it was kind of a wild week, right? But we ended just mildly where we began the week. I mean, the week literally began at 33, 33.40. That's this center line is where the week began. We end the week at 33.20. Like net, what did you lose? Absolutely nothing. But here's the part that really gets me. So the expected move in the previous week was basically $100. That's $100 higher or $100 lower. We see some pretty wicked movement, and yet they contract the expected move to $83 higher or $83 lower. Here's another time, and I don't mind saying this again. I'm not going out there and selling options premium into this. An $83 expected move. Oh, okay. We already traded all the way down to what? 32.80 inside of the S&P futures, today. So with Mr. Toad's wild ride on the loose over here, I'm not going to be a premium seller anytime soon. Again, if you're looking for the bigger takeaway from this weekend's update, that volatility is perplexing. But in my mind, all roads lead to the fact that we have to feel the fear in this marketplace, and we just haven't. Now, that does not necessarily constitute the fact that we can't rally back. Like, I don't want to be, misinterpreted in this, okay? A rally back, though, at this point is, for me, it's not an opportunity to buy a dip. Because every time you come in here and you're going to see dip buyers in there, right? What's going to occur is people are going to get their money back. And remember, this is a largely retail-driven marketplace. And if there's one thing after 15 years of me at Thinkorswim and TD Ameritrade, I was in the brokerage business for 15 years. I studied retail clients for over 15 years. There's one thing I know, it's the retail side of the business. Okay? What you have right now are retail traders that are hanging on, okay? Like it's grim death in the S&Ps. But when we rally, okay, and we will rally and people will step in and buy this and there'll be some short covering in here. Those people that are just hanging on down here can't wait to bail. And it's going to shove us right back into a tailspin. So there is no easy path to the downside, okay? But believe me, there's going to be more downside in here. And we're just not going to get there until that volatility really starts to explode. Look for some wild move to the upside. That's fine. But at this point, you're not going to buy the dip. You got to go out there and sell some of the rips. Thanks, everybody, for joining us here at TheoTrade. Have a wonderful weekend. Bye-bye.